Welcome to this explainer, where we're diving straight into the hidden political machinery that actually designs our banking systems. Whenever a massive financial crash hits, it's super easy for pundits and commentators to just point fingers at greedy Wall Street executives, complex derivatives, or unpredictable market shocks, right? We're constantly told that commercial banking is just inherently fragile, like a giant house of cards just waiting for a stiff breeze. But today, we are completely shattering the myth that financial crashes are just inevitable market accidents. We'll be leaning on some monumental research by financial historians Charles Calomiris and Stephen Haber to show you that our financial systems are exactly as fragile or as resilient as they were intentionally designed to be.
To really grasp how profound this idea of intentional design is, I want you to consider a pretty jarring number, 12. The United States has suffered through 12 major systemic banking collapses since its founding. Think about that. 12 different times the financial system basically short-circuited, wiping out savings, destroying businesses, and requiring massive, desperate interventions. Now, if banking crises were just random acts of nature or unavoidable quirks of capitalism, well, you'd expect every modern industrialized nation to have a similar track record, right?
But look right next door. Sharing a massive border and a very similar economic history, Canada has experienced exactly 0 systemic banking crises in over 200 years. Literally, 0. During the Great Depression, when thousands of American banks went under, not a single Canadian bank failed. And fast forward to the 2008 subprime collapse, Canadian banks remained completely solvent, totally profitable, and required absolutely 0 government bailouts.
So this incredible statistical discrepancy begs the ultimate question. How on earth can two wealthy neighboring democracies have completely opposite track records when it comes to keeping their citizens' money safe? I mean, they both developed out of British colonial origins, they both have vast agricultural expanses, and they both went through rapid industrialization. The secret isn't geography. It certainly isn't some inherent moral superiority. Actually, the secret is entirely political.
The real answer lies in what Calomiris and Haber call the game of bank bargains. This concept is a real paradigm shift because it proves that banking systems don't just naturally evolve in some free market vacuum. No, they are intentionally engineered through intense political horse trading. Depending on who holds power in a given country and what political coalitions form, the resulting banking system is going to deliver either rock-solid stability or catastrophic financial crashes.
To actually understand how this game is played, we have to look at the 4 key player groups who are constantly battling over the rules. First up, you have politicians. They always need revenue and debt financing, but they really want to avoid raising unpopular direct taxes. Then you have the bankers, who are always seeking exclusive monopoly charters and, of course, high profits. Next are the borrowers. This is everyone from massive corporations to local farmers, and they all want cheap credit tailored specifically to their needs. And finally, you have depositors. That's everyday citizens like us who just want total safety and on-demand access to our money. The constant tug-of-war between these 4 groups creates intense conflicts of interest that make banking inherently political.
Okay, let's see how this actually played out historically, starting with the United States. Back in its early years, agrarian populists and local politicians struck a very specific bargain. State legislatures quickly realized that granting local bank charters was a highly lucrative source of revenue for the state. But to maximize that value, they legally restricted banks to a single physical town. This created the infamous American system known as unit banking. Now, for small-town merchants, this probably seemed like a populist dream, keeping money local and out of the hands of big New York financiers. But economically, it created an absolute ticking time bomb. Here's why. America's isolated unit banks were structurally designed to fail the moment a local crop failed. Think about it. If you were a unit bank in an Iowa corn farming county, your entire balance sheet depended entirely on the price of corn. If a drought hit, everyone defaulted, and the bank just went broke because it legally couldn't open branches anywhere else to spread the risk. Now contrast that with Canada's nationwide branch networks. The Canadian political bargain established a few large, diversified national banks. So if a drought hit prairie wheat farmers in Saskatchewan, the bank didn't fail. Those local losses were easily offset by profits from manufacturing over in Ontario or mining out in British Columbia. Capital just moved seamlessly across the country to absorb the shock. America's underlying structural fragility eventually came to a catastrophic head during the Great Depression. That fragmented unit banking structure just collapsed on an unprecedented scale. Between 1930 and 1933, over 9,000 American unit banks failed. That entirely wiped out millions of family savings accounts, a truly devastating blow to everyday citizens. Politicians obviously had to step in. Now, the logical fix would have been to finally adopt Canada's nationwide branch banking model, right? But the political coalition of small unit bankers was still way too powerful in Congress, and they fiercely fought off big branch banks that would outcompete them. So, instead of fixing the underlying structural flaw, those powerful unit bankers found a workaround. They successfully lobbied for deposit insurance, which led to the creation of the FDIC. Now, on the surface, this protected small depositors and stopped the immediate bank runs. But beneath the surface, it fundamentally altered how the public behaved and introduced a severe new problem: systemic moral hazard.
The crucial point here is that before deposit insurance, you actually had a strong incentive to monitor your bank. If you thought they were taking reckless risks, you pulled your money out fast. But by guaranteeing deposits, the government inadvertently removed that incentive entirely. Suddenly, a dollar in a wildly speculative bank was just as safe to the depositor as a dollar in a super conservative one. This allowed reckless banks to attract billions just by offering slightly higher interest rates. If their high-risk loans paid off, the bank owners made massive profits. But if they went bust, taxpayers picked up the tab. It was literally the ultimate heads-I-win, tails-you-lose scenario.
All right, which brings us to the modern era. Let's see how this exact same lens of political bargaining applies to the definitive financial calamity of the 21st century, the 2008 subprime mortgage collapse. Mainstream commentary almost always frames 2008 as this sudden market failure driven purely by unregulated Wall Street greed. And sure, while greed definitely played a role, the true underlying driver, the secret pipeline of risk, was actually a brand new political bargain struck in Washington during the 1990s.
Calomiris and Haber describe this setup as a classic Baptists and bootleggers coalition. If you don't know the term, historically, it refers to religious groups wanting Sunday liquor sales banned for moral reasons, forming an alliance with illegal bootleggers who wanted the exact same ban just so they could sell alcohol at a huge premium. In the banking world of the 1990s, the Baptists were well-meaning community activist groups and politicians who genuinely wanted to expand homeownership for low-income families. And the bootleggers? Well, they were the massive, profit-seeking commercial megabanks and government-sponsored enterprises. Step by step, this unholy political bargain was built. First, activists used regulations like the Community Reinvestment Act to legally challenge and hold up major bank mergers. Second, to get those highly lucrative mergers approved by the government, megabanks pledged to originate hundreds of billions of dollars in subprime, zero-down payment loans. And third, to make this reckless lending sustainable for the banks, the government mandated that Fannie Mae and Freddie Mac buy these risky loans to hit federal affordable housing quotas. So banks happily originated dangerous loans specifically because they knew they could immediately offload that toxic debt right onto the government.
The result of that specific political bargain is just staggering. By 2007, an astonishing 67%, literally two-thirds of all high-risk subprime mortgages, were actually held or guaranteed by government agencies, state-regulated banks, or government-sponsored entities. This wasn't just some free market accident. It was a self-reinforcing financial pipeline perfectly engineered by a political coalition, absolutely guaranteeing a systemic crash the moment housing prices finally stalled. In the wake of the 2008 crash, the official response was to pass massive, sweeping legislation like the Dodd-Frank Act. But assuming we can fix this with thousands of pages of complex micro-regulation is a total fallacy. It completely ignores the underlying political incentives that drive the actual risk in the first place. Regulators aren't some omniscient referees standing completely outside the system. They are public employees who report to politicians, and those politicians respond to interest groups. Legislation like Dodd-Frank didn't dismantle the core political bargain. It just added layers of bureaucratic rules that actually burdened smaller banks while strengthening the megabanks deemed too big to fail.
So how do we actually escape this trap? Well, Calomiris and Haber lay out 4 definitive, structural rules to build a banking system that is strong by principle rather than fragile by design. First, establish broad-based, nationwide branch banking to diversify geographical risk, just like Canada does. Second, impose strict, unyielding capital requirements. Bank shareholders must have real skin in the game and face total ruin if they take reckless risks. That neutralizes the moral hazard. Third, explicitly insulate financial regulatory oversight from partisan political manipulation. And fourth, if society decides it wants to subsidize housing or small businesses, use transparent legislative subsidies funded by explicit taxes rather than hiding those mandates off-budget inside the banking system.
To wrap up our explainer today, I want to leave you with a crucial question. Building a stable banking system isn't just some complex math problem. It's a political challenge. The safety of the money in your account and the overall stability of our economy are determined by this game of bank bargains. So the very next time you read the financial news or see politicians promising a shiny new regulation, a mortgage subsidy, or a massive bank bailout, take a step back and ask yourself, who actually benefits from this specific bargain and who, ultimately, bears the hidden risks? Keep that question in mind, and you will start seeing right through the political rhetoric. Thanks for joining me on this deep dive, and as always, keep questioning the design of the world around you.